Okay, so the RBA's come out this month and raised interest rates at 25 basis points or 0.25%. And that's come as a little bit of a shock to some people because it wasn't that long ago. It seemed like there was still talk of potentially further rate cuts. And so I wanted to do a quick sort of recap and talk about what's changed and where do we think interest rates are going to go from here, because certainly that's going to be a question on many people's minds. So I think it's really important to understand when it comes to interest rates and what the interest rate setting is. And we've talked about this in other videos, so certainly check out our videos on inflation and CPI as a good example. But it's really important to understand that the RBA, when they're setting interest rates, it's very difficult to try and articulate exactly what it is they're trying to do. Because once upon a time, the RBA had a relatively clear mandate, but that mandate seems to have changed a bit over the years. So all we can really guess now in terms of what the RBA is trying to do with interest rates is try and control the aggregate of prices that they seem to care about at a particular point in time. Now, again, I'm not going to go into a lot of detail in this video because we've talked about that ad nauseum in other videos, but interest rate expectations are really an important factor of the markets, is why markets like to talk about them a lot. But the reality is the RBA has very limited scope to drive where market interest rates are going, because most of the bank funding and most of debt funding now isn't funded directly from the RBA. It's well less than 50%. So bond markets, the investment markets are a big driver of what those rates are. And that will be a much bigger impact when it comes to things like, should I fix home loan rates and those sort of things, because it's those market rates that ultimately determine where fixed rate mortgage prices go. And so those of you who do have debts are thinking, well, should I look at fixing? We'll go through and look at where we think interest rate, the expectations are from a market perspective. But the reality is as soon as the market expects rates to move, then those fixed rates adjust automatically in line with that expectation. They don't really wait for that official move. Therefore, there's not necessarily a major change in rate expectations just because the RBA moves. So if we have a look at this graph here, we can see that this is looking at this is only a month ago, this particular slide was looking at the rate expectations. So going back to the 9th of January, so literally just a month ago, what was the market essentially saying in terms of the applied bond yield rates, if you like, as to where the market we're expecting the RBA to send future interest rates. And we can see that whilst the current rate was sort of around 3.6, there wasn't much expectation even a few weeks ago that rates would go up inside the very next meeting, but that they would actually be up to one rate rise of 0.25% by sort of August. So we're sort of in about 6 months' time, the market was expecting that there's a reasonable chance that by then the RBA will have raised rates. Obviously, it ended up accelerating because of some of the economic data that came out from the December quarter in particular. And so the RBA has moved ahead of the curve, if you like, to try and raise rates. But you can see that the market expectation, while there was a pretty much 100% expectation of rates rising by August, that there really isn't an expectation, or there wasn't at that point, that rates would get any higher than that. Right out until sort of June 2027, there's really only a very small chance of a rate rise being any further than that. Now, that's obviously changed a little bit because the RBA have come and raised rates sooner than the market was expecting, even only a few weeks ago. But the market hasn't reacted in a way yet where they're expecting further rate rises to necessarily steepen that curve or continue the steepness of that curve. And so where does this sit in terms of expectations? Because again, as I said, it wasn't that long ago people were talking about the potentially even one or two more rate cuts going into the future. And I guess it's really important to look at, well, yes, certainly people were talking about that, but they were only talking about that, again, not that long ago. I think it's useful to go back and look at what were market expectations some time ago and how did that play out, because we can often get caught up too much in the short-term reactions of markets rather than taking a bit of more of a medium to long-term view and seeing how do things play out versus that medium to long-term view. So if I switch back to say, well, what was the expectation this time last year? If I go back to, this is now looking at essentially 12 months ago, so February 2025, although that does say 24 there. This is a 2025 chart. So we can see here that back then rates were higher, and there was an expectation. So this is our 3.6 mark along here, the second from the bottom. And you can see that the market was expecting rates to be down at 3.6 by the end of 2025, which obviously they were, and that they would be pretty much flat out beyond that. You can see here no real expectations of further rate cuts, even though some were still talking about it late last year. But if anything, there would be a pausing of rates, if you like, into the foreseeable future. So yes, we saw that the rates come down at 3.6. But again, the expectation in the medium to long term is the fact that rates weren't necessarily going to drop any further, and no expectation of increase. Now, what does this really mean? This is really the bond markets and interest rate markets saying beyond 6 months, we don't really know. So we're just going to flatten the curve out at that point. And so in reality, if we were to take a view of what did the market think 12 months ago and how did interest rates play out? Well, they played out really pretty much exactly as expected. We got to that bottom. The difference is from there, rates have begun to drift a bit higher. And so if I look at where, again, getting back to this now current rate expectations from January 2026, an expectation that rates would rise by one rate rise of 0.25%, but they're really now a flattening out of that into the foreseeable future. And that's pretty much where we sort of sit from an expectation point of view. Obviously, something that we'll continue to monitor. It will have some impact a little bit in terms of positioning portfolios. But at the moment, the bond market or interest rate markets aren't really reacting aggressively one way or the other. There's no real expectation now that there's going to be a huge series of continual rate rises. It doesn't look like there's going to be any drops anytime soon, obviously, but it's really the RBA, I think, just playing around at the edges because they don't really know where things are likely to go from here. And they're going to be a little bit more cautious and raise rates and therefore restrict supply, if you like, try to bring prices down in the aggregate, which is allegedly what they try to do with these rate rises, and slow the rate of credit growth. Okay, so this is really about the rate of credit growth, not necessarily the amount of credit being issued, but how rapidly is that increasing or decreasing. And obviously the RBA is unhappy with what they perceive to be the rate of growth in credit. So not the amount of credit, the rate of growth in that credit. Okay, so it's a little bit complicated, but it's the rate of growth that matters, not the actual growth. And a change in the rate of growth, positive or negative, is the thing that will ultimately have big impacts in terms of whether it will feed into, downturns and recessions and those sort of things. So we're not seeing that at the moment. Obviously, it's something we'll keep an eye on going forward in the coming months. But at the moment, it's more, you can think of this as more of a bit of a nudge along the sides rather than, a massively changing change of direction. Some are regarding as a change in direction, but that was based on the idea that their rates were going to cut further. And as we looked just a minute ago, we can see that if we go back 12 months ago, there hasn't really been an expectation that rates would get much lower than the current level from the markets themselves. That's been more a bit of speculation by, I guess, economic commentators on whatever they thought their own opinions were, but the markets haven't really played that out. So for now, it's very much a, hold position. As I said, rates don't look like, from a fixing perspective, where we look at mortgage rates, they don't look like there's any real value there. Similarly, term deposit rates obviously are looking slightly more attractive, but again, most of that is relatively built into the market. We're not seeing major increases in medium to long-term rates because the long-term shape of the yield curve haven't really changed too much. So I just wanted to give a quick update, just because obviously we are in the news cycle around interest rates. It's not a big change, even though it can, it's certainly being reported by some as a change. It's not. It's more of just a change around the edges. So you can see from these current yield curves that we're not expecting rates to change drastically one way or the other. We think that they'll, for the rest of the year, if you like, we should be sort of reasonably steady. But obviously we'll keep an eye on that and we'll give further updates if we think they're necessary.